Welcome to UK Property Info. Something happened this week that sent shockwaves through the housing market. And if you own property in the United Kingdom, you need to understand exactly what occurred and what it means for the value of your home. Before I explain the trigger and break down the implications, I want to ask you one simple favour. If you find this channel helpful, please take a moment to subscribe. We are working hard to grow this community of informed property owners. And that single click helps us reach more people who need to understand what is really happening in the UK property market. Now, let me tell you about the event that caused millions of UK homes to lose value practically overnight. When I say homes lost value overnight, I am not being dramatic for effect. I am describing what actually happened in the perception of property worth across the entire United Kingdom. The trigger was not a single catastrophic event like a financial crisis or a government collapse. It was something more subtle but equally powerful. It was a shift in market psychology that occurred when several negative signals aligned at exactly the same moment, creating a perfect storm that fundamentally altered how buyers, lenders, and valuers assess UK property. Understanding this mechanism is crucial because it reveals how fragile property values actually are and why the next overnight drop could be even more severe. Let me explain exactly what happened. On a single day last week, 3 separate pieces of information hit the market simultaneously. First, the Bank of England released updated guidance suggesting interest rates would remain higher for longer than markets had anticipated. The expectation of rate cuts in the first half of this year evaporated. Second, major mortgage lenders announced they were tightening lending criteria, reducing the loan-to-income multiples they would accept, and increasing the stress test rates they apply to affordability calculations. Third, a respected property index published data showing transaction volumes had fallen to their lowest level in over a decade, with the number of completed sales down more than 35% compared to the same period last year. Any one of these announcements would have been concerning. All 3 arriving on the same day created a psychological tipping point that changed how the entire market values property. To understand why this matters, you need to understand how property values actually work. Most homeowners assume their property has an objective value determined by factors like size, location, and condition. But that is not how markets function. Your home is worth exactly what a qualified buyer can and will pay for it, nothing more. And when buyers suddenly cannot access the financing they need, or when they become convinced that prices are falling, or when fewer buyers are competing for properties, the amount they can and will pay drops immediately. This is not a gradual process that takes months to work through the system. It happens instantly. The moment lender criteria tightened and rate cut, hopes faded. The maximum amount a typical buyer could afford to pay for your property dropped by thousands of pounds. That is not a prediction of future decline. That is an immediate mathematical reality. Let me put specific numbers on this. Before the announcements, a buyer earning £60,000 per year with a 10% deposit could typically borrow around £270,000, giving them a maximum purchase budget of around £300,000. After the tighter lending criteria were announced, that same buyer can now only borrow £240,000, reducing their maximum budget to around £270,000. That is a £30,000 reduction in buying power. For sellers whose properties were priced at £300,000, the pool of buyers who can afford that price just shrank dramatically. And when there are fewer qualified buyers at any given price level, prices must fall to find equilibrium. This is basic economics, but its implications for homeowners are profound. The speed at which this repricing occurs is what catches people off guard. When new mortgage products are launched with tighter criteria, every buyer in the market is immediately affected. When valuers and estate agents read the same negative news, they immediately adjust their price guidance downward. When sellers see reduced interest in their listings, they immediately start considering reductions. The entire ecosystem adjusts within days, not months. This is why I say values dropped overnight. The physical property did not change, the location did not change, but the amount buyers can pay and the amount lenders will advance changed the moment those announcements were made, and property is worth only what the current market will pay for it. Now, you might be thinking, this only affects people who are currently trying to sell. If you are staying in your home, surely the value fluctuations do not matter. That perspective is understandable, but it misses several crucial ways that overnight value drops affect all homeowners. First, your remortgage options depend entirely on current valuations. If your property is worth less than your lender's automated valuation model suggests you may not qualify for the rates you expected. You could be forced onto higher rates or even find yourself unable to remortgage at all if your loan-to-value ratio has deteriorated. Second, your equity is your financial security. Many homeowners are relying on property equity to fund retirement supplement income or pass wealth to the next generation. When values drop, that security diminishes. Third, and this affects more people than you might expect, negative equity can become a trap. If values fall enough that you owe more than your property is worth, you cannot sell without bringing cash to the table. You become locked in place, unable to move for work, family, or lifestyle reasons. The overnight drop we witnessed this week was not the first, and it will not be the last. Property markets are subject to sudden repricing events whenever significant news changes, buyer behaviour, or lender policies. What makes the current environment particularly dangerous is that we are seeing a series of these shocks occurring at shorter and shorter intervals. A year ago, the market absorbed negative news and continued functioning relatively normally. 6 months ago, each piece of bad news caused a wobble that took weeks to work through. Now the market seems to be reaching a state where each new shock builds on the previous one, creating cumulative effects that compound rather than dissipate. This pattern is deeply concerning for anyone holding property wealth. Let me explain the specific triggers that are most likely to cause additional overnight drops in the coming months. The first and most powerful trigger is interest rate announcements. Every time the Bank of England meets, markets hold their breath. If rates rise, or if guidance suggests rates will stay higher for longer, mortgage affordability calculations change immediately. Lenders update their products within hours. Buyer budgets shrink within days. The second trigger is lender policy changes. Even without Bank of England action, individual lenders can tighten criteria at any time. When one major lender makes a move, others often follow within days, creating a cascade effect that reduces available credit across the entire market. The third trigger is economic data releases. Unemployment figures, inflation data, GDP numbers all influence market confidence. Negative surprises can shift buyer psychology overnight, causing viewings to cancel and offers to be withdrawn. The fourth trigger is political announcements. Changes to stamp duty capital gains, tax landlord regulations, or housing policy can immediately alter the investment calculus for buyers. We have seen governments make sudden announcements that wiped billions off property values within hours. The fifth trigger is global financial events. UK property is connected to international capital flows. When global markets wobble, when other countries experience financial stress, when currency movements make UK property more or less attractive to foreign buyers, values adjust accordingly. The sixth trigger is seasonal and sentiment shifts. Sometimes market psychology tips without any single identifiable cause. Enough negative stories accumulate, enough sellers reduce prices, enough buyers delay purchases, and suddenly everyone agrees that property is worth less than it was. These consensus shifts can happen remarkably quickly. What does this mean for you as a homeowner or potential buyer? If you currently own property, you need to accept that the value you see on property websites or in estate agent estimates is not real money until you actually sell. Those figures can change by 5 or 10% in either direction based on news events you cannot predict or control. Building your financial plans around property wealth that could evaporate overnight is risky. This does not mean property is a bad investment. It means you should not treat unrealized property gains as guaranteed wealth. If you are planning to remortgage soon, do not wait until the last moment hoping for better rates. Lock in acceptable terms when they are available, because the market could shift against you overnight. If your current mortgage is affordable and your loan-to-value ratio is healthy, consider whether fixing for a longer term provides valuable certainty, even if the initial rate is slightly higher. If you are considering selling, the lesson from this week is that pricing accurately from day one is more important than ever. The days of testing the market at an ambitious price and gradually reducing are over. In a falling market, every day you are overpriced is a day your property loses value. Serious sellers should price realistically based on current conditions, not based on what similar properties achieved 6 months ago. Be prepared to move quickly when offers come in. In unstable markets, deals can collapse and conditions can change, before transactions complete. Anything that delays exchange increases your risk exposure. If you are a buyer, the overnight drop actually creates opportunities. When values fall quickly, sellers panic. Motivated sellers who need to move become more flexible on price. Properties that were out of reach last month might be achievable this month. But you need to balance opportunity against risk. Catching a falling knife is dangerous. Buying today, when prices might be 5% lower, next month is painful. There is no way to perfectly time the market, but you can protect yourself by negotiating hard, by ensuring your mortgage offer has enough headroom to survive a valuation wobble, and by having backup options if your preferred purchase falls through. For landlords, the implications of overnight value drops are particularly significant. Your ability to refinance depends on property values. If your portfolio has lost value, your loan-to-value ratios have worsened, which affects the rates you can access, and potentially your ability to meet lender covenants. If you are considering selling some properties to reduce exposure, the same pricing pressure affects you. Properties that would have achieved certain prices 3 months ago may not achieve those prices today. The rental yield calculations that justified your purchases may no longer work if you were relying on capital growth to compensate for thin cash flow. The overnight drop forces a fundamental reassessment of whether property investment still makes sense at current prices and financing costs. Looking at the broader market trajectory, the conditions that created this overnight drop are not going away. Interest rates are likely to remain elevated for the foreseeable future. Lenders are likely to maintain tight criteria given economic uncertainty. Transaction volumes are likely to remain depressed as buyers and sellers struggle to agree on prices. This means the potential for additional overnight drops remains high. We could easily see another similar event in the coming weeks if inflation data disappoints, or if another major lender tightens criteria, or if unemployment figures surprise to the upside. The market is fragile, and fragile markets break suddenly rather than declining gradually. The regional picture adds another layer of complexity. Not all areas experience the same degree of overnight repricing. London and the southeast, where prices are highest and affordability is most stretched, saw the sharpest adjustments. When buyers in these regions lose borrowing capacity, the effect on prices is proportionally larger. The Midlands and northern regions, while not immune, saw more modest adjustments because prices are lower in absolute terms, and affordability was less stretched to begin with. However, these regions are now seeing secondary effects as buyers, who would have purchased in more expensive areas, redirect their attention northward, increasing competition and potentially supporting prices. Wales and Scotland have their own dynamics influenced by different policy environments and market conditions, but nowhere is immune from the fundamental forces at play. Tighter lending and higher rates affect every buyer in every region. What should you actually do with this information? First, assess your current position honestly. What is your property actually worth in today's market, not what you hope it might be worth? What is your loan-to-value ratio? How secure is your mortgage situation? How would you cope if values fell another 10 or 15%? Second, consider your time horizon. If you are staying in your property for 10 or 20 years, short-term value fluctuations matter less. Property has historically recovered from downturns over time. But if you need to access your equity in the next few years through sale or remortgage, the current volatility is a genuine risk. Third, stay informed. The homeowners who got caught off guard this week were those who were not paying attention to the warning signs. The rate cut expectations fading the lending criteria, tightening the transaction volumes falling. None of this was secret information. It was all visible to anyone who was watching. But most homeowners do not watch. They assume their property value is stable and permanent, until suddenly it is not. The property market has entered a new phase of volatility that most current homeowners have never experienced. The long period of steady growth, interrupted only briefly by the 2008 crisis, created an assumption that property values only go up over time. That assumption is being tested. Values can and do fall. They can fall quickly. They can fall by amounts that wipe out years of supposed gains. This is not meant to frighten you into selling, or to suggest that property is no longer a valuable asset. It is meant to ensure you are making decisions based on reality rather than assumptions. The homeowners who navigate this period successfully will be those who understand that their property value is not guaranteed. Those who treat fluctuating paper values as real wealth will be caught off guard again and again. Thank you for watching UK Property Info. We will continue to monitor the market and explain what is really happening behind the headlines. If you found this analysis valuable, please share it with other homeowners who need to understand what triggered this overnight drop and what might trigger the next one.